Welcome to a new episode of BFRR, our Bitcoin, Fiat and Rock and Roll podcast that explores the intersection of traditional finance, digital assets and digital money, and helps you understand how digital assets and digital money will evolve in the future. I'm co-host Michael Blaschke, and today I am joined by our guest Simon. Simon Seiter is Managing Director and CFO and CPO at AllUnity, the stablecoin venture backed by DWS, Galaxy Digital and Flow Traders. Before joining AllUnity in early 2025, Simon spent 3.5 years as head of digital assets at Hauck Aufhäuser Lampe, one of Germany's oldest and most established private banks, where he built the digital asset business line essentially from the ground up. He also chaired the supervisory board of Hauck and Aufhäuser Innovation Capital, which became the first fully licensed crypto asset management company in Germany under BaFin supervision. So Simon has done something very few people in the industry can actually claim. He's built institutional DLT infrastructure from inside a traditional bank and then moved to the other side to build the on-chain rails that banks will need to connect to. That trajectory makes him one of the most interesting people to talk to about what it actually takes to bring stablecoins to institutional grade production in Europe. Hi Simon, great to have you with us today.
Thanks for the intro, Michael.
Yeah. Are you happy with your intro, Simon, or is there anything to add from your perspective?
No, more than happy. Couldn't have done it better myself. Actually, I think I have to steal a bit the angle that you presented it. It's a very good angle. But it's good that you did it, because if I did it the same, maybe it looks a bit like I'm a bit like too convinced of myself. Yeah.
Yeah, so super happy to offer you an angle that you can use in further introductions or pitches about your person. Yeah, Simon, everyone's talking about stablecoins right now. New issuances, new regulatory frameworks, new announcements every week. But most of that conversation stays at the surface. Who's launching what token on which chain? What almost nobody talks about is what has to exist beneath the token for it actually to work at institutional scale. And we're talking about custody architecture, reserve management, settlement design, compliance layers, banking relationships, smart contract governance, interoperability, the full stack that a bank, an asset manager, or a payment provider needs to trust before they touch a stablecoin in production. And that's what this episode is about. AllUnity just announced a Swiss franc denominated stablecoin alongside your Euro stablecoin. And rather than just covering the announcement, we want to use it as a lens to look at the engineering and the strategic decisions underneath. So what does enterprise-grade stablecoin infrastructure actually look like under the hood? Where does traditional finance architecture break when you bolt on blockchain? And many more of these questions. Yeah, and that's why the title for today's episode is The Layer Below the Coin, and that's exactly where we're going. AllUnity just announced the Swiss franc denominated stablecoin, as said, and on the surface, that's really a product announcement if you read the articles. But to us at BFRR, it really reads more like an infrastructure signal. It suggests the underlying architecture was deliberately designed at AllUnity to be multi-currency from the beginning. So before we get into the what and the how, let's start with the why. What actually triggered the decision to go Swiss franc, and why now?
So you're completely right with the strategic decision to build an infrastructure that is multi-currency based. And why is this the case? Because we believe, of course, that one of the key elements of stablecoins is to allow for very efficient global payment mechanisms. And we have seen this already in the industry, because in an unregulated manner, this already happens right now. We see a lot of remittance, especially in South America, that are being delivered by stablecoins. Yet, of course, this happens in corridors where the single focus on US dollar is very strong still, and where it is an advantage actually. And this is, of course, why it's being used in South America, because people in South America need US dollar anyhow. Stablecoins in US dollar are an easy way to get US dollar exposure. And it is here a feature that you can get only the US dollar while it is not a feature to be regulated because the people don't really care. They are happy to have US dollar exposure anyhow. What it shows, as we have seen also in the blockchain use cases over the last couple of years, is the technology is working. Indeed, the mechanisms behind it are efficient, but still, of course, corporates, institutionals don't adopt it yet to full extent. The reason herefore is it's not regulated. So our focus at first is, of course, to build a regulated stablecoin. But then we still see the advantages, of course, that it brings with it for global payments. So we also framed it in a way that we are like going around and telling, we will build an infrastructure that will enable global payments as efficient and regulated as SEPA Instant. And that's the message that we are bringing actually to the corporate institutional clients. If, however, the corporate and institutional clients want to act like that, only transfer of value is not enough. You have to be also able to deal with multiple currencies simply because they balance in multiple currencies, they pay in multiple currencies, they make deals in multiple currencies. So if you want to enable global payments, you cannot just do it with euro or only with US dollar. You will have to be able to do multi-currency. And so next step then for the decision to go multi-currency, coming from the strategic vision of global payments in an efficient and regulated manner for corporates and institutions, is then the question, which currency? And herefore, the simplest step is, of course, currency that can be enabled within the regulatory framework of MiCA, which we are licensed to. So the MiCA framework foresees that you can use currencies that are established in the EEA, so in the European trading area, to put it simple. And here actually the Swiss franc is part of that, because the Swiss franc is also a legal currency in Liechtenstein, which is part of the EEA. While in the Switzerland directly, there is yet no regulatory framework for a stablecoin, which means there is actually market demand because the Swiss franc is a very well-established, very stable currency with no local regulatory framework in Switzerland. But it is possible within MiCA to launch a Swiss franc-based stablecoin because it is a legal tender actually within the EEA through Liechtenstein. And for that reason, we also, of course, looked for client demand. And indeed, we also recognized client demand. So this is basically where all spots came perfectly together, because you have client demand, you have a niche that is not yet attacked, and you have the regulatory framework and also, as you mentioned, the infrastructure already to provide a product. So you have a very good product market fit. And this then ultimately led to the decision, also coming together with the fact that the partners that we're working with together could also enable settlement in Swiss francs and stuff like that, that we're going to tackle this market also, to be honest, pretty quick out of our perspective for a regulated product. I mean, what we try to prove as well is that we can launch regulatory compliant products in quicker time than maybe more well-established market players, because we are building, or we have built, a new infrastructure from scratch that is STP, and at the same time also show that it works in regulated fashion, And I think an advantage here from the infrastructure layer, because you mentioned it beforehand, is definitely that we have built this infrastructure newly from scratch, which enables automated processes, straight-through processes, which you cannot do if you build on existing infrastructure that is not on this technical level. And there are also competitors in the market, to be honest, that are launching products in a less automated way, even though they also started new from scratch, because they wanted to have a quicker time with go-to-market for the first product. But our idea was we want to build an underlying infrastructure that will enable then scaling better. And for that reason, of course, it's now for us easier to launch further products. Because if you have not this underlying scaling infrastructure in multiple dimensions, technologically, reserve side, whatsoever, every additional product means a lot of additional manual effort. And this manual effort will, of course, also scale negatively Yeah, so it will lead to issues if you have to do everything with manual processes, like a minting that is being kind of ordered through an email. That doesn't work to scale. Yeah.
Before we jump back into today's episode, let me make you aware of the Digital Euro Conference 2026 happening on March 26. The DEC is one of Europe's key events when it comes to digital money, bringing together central bankers, regulators, banks, fintechs, crypto innovators, and industry leaders to explore where money is headed. This year's focus goes beyond the digital euro itself. They will talk about where we stand from piloting to real-world rollout. It also looks at how stablecoins and commercial bank money tokens are shaping the future of payments. You will hear from speakers from institutions like the Bundesbank, Bank of Italy, Banque de France, the International Monetary Fund, the European Commission, and experts from tech, finance, e-commerce, the blockchain space, and many more. You can join the event, the DEC 26, in person or online. And if you're interested, feel free to use the discount code BFRR20 to get 20% off your ticket, and check the show notes for details. Hope to see you soon in Frankfurt.
Yeah, so to summarize, you outlined two forces that drove AllUnity into this push. One is demand, so institutional clients, the Swiss market, DeFi liquidity needs. And on the other side, you described AllUnity's capability. Let's say the architecture was ready, so why not? And can you give us an intuition of how much of this move is pulled by demand, for example, institutional clients, versus pushed by the capability of AllUnity, that is, your architecture is from the outset multi-currency?
Yeah, I think to be fair, it's pretty hard to have a ratio, because it's like two different layers, so to say, because you can only fulfill the demand if you have the infrastructure ready. But I would say, like, I would put a different ratio onto it. As I would say, the capability enabled us to launch it 3 times quicker than we could have, even if the demand was there, and we would have to build it separately again from scratch. Yeah, that is something that I see. Like, it's a factor in terms of scaling, in terms of time to market. Yeah. Of course, some things have to play together because there are a lot of steps involved, also partners, service providers involved, that if they were not able, for example, to deal with Swiss francs, this would have been also difficult for us, where we will also even further enlarge our partnerships in order to, again, increase capabilities to scale. Yeah, but to come back to your question, I think it makes it 3 times faster, yeah, to pick up the market demand by having this infrastructure.
Yeah, so maybe we should also invite Peter Großkopf, your CTO, who I bet had a large say in the decision to build a scalable platform. I think you referred to it as STA, the infrastructure you built.
Straight for processing, yeah, and for sure with Peter, yes.
Yeah, but that's certainly smart, yeah, and that's a good architectural choice to build whatever infrastructure you build, to have it multi-currency, to have it future-ready. A big lesson learned for all the other stablecoin issuers out there, I bet. Yeah, to me, this move, so AllUnity in itself, but also the move to add a currency now is one aspect of a broader phenomenon that is the institutional race out there to build now. A year ago, most European banks or institutions in general were still in, I call it, watch and learn mode on stablecoins. And now we're seeing DWS-backed AllUnity or SC Forge with Euro convertible. Deutsche Bank is exploring tokenized deposits. What changed? Is this herd instinct, so of fear of missing out, or did something structurally unlock that now we have this institutional race to build?
The banks moved. To put it shortly, I think when we started, we didn't even get a bank account even. So getting a bank account was really on our critical path to launch, the most critical part, which is kind of funny. Yeah. If you consider now that all the banks are starting to think about use cases and build-ups and so on. So I think the DeFi world was already on stablecoins, yeah. And then we had MiCA as a regulatory trigger point. But even then, there were only a few, so SocGen, basically, to be honest, yeah, that went into the topic, yeah, as a first mover. And there was not really a follower. If you go back already a year ago only, I mean, we were already like announced to go live, but also with no like direct investor, like a bank as a direct investor. Yeah. I mean, DWS is of course also a company that is within the group of Deutsche Bank, but it's an asset manager. Yeah. And then we have a large digital asset institution with Galaxy and Flow Traders as a market maker. No bank involved. And SocGen back then was the only bank that moved into that space. Yes, there were plans behind the curtains and stuff like that, but nothing really moved. And then they picked up kind of stablecoin summer, how I would call it, and FOMO. And as always with institutions, having worked also for Deutsche Börse and Commerzbank, I know it pretty well, where they saw that they might lose existing business. And it's not the opportunity of new business that triggers this change. And you can see it also right now in how they move. The only bank that has, from SocGen then on, launched a stablecoin was, I think, Oddo. Yeah, the smaller French-German private bank, Oddo BHF. Besides, no bank since then launched a stablecoin. What happened instead? Large consortia have formatted. Nothing new. This is the same development for tackling new payment mechanisms as a bank that we have seen 10 years ago with PayPal competitors. When I started in Commerzbank, there was still a project running around a so-called company of PayDirect. PayDirect was assumed to be the German PayPal competitor, and then later on integrated into EP and now Vero, and you find some rest of it still there. So the topic of, hey, there's a new player on the market, mostly US company, that provides an innovative payment product, and not only they get some new business, but they actually take away our existing business, for example, credit card business, yeah, as a merchant bank. This has happened before. And the answer back then was also, hey, let's build a consortium. I have made, in the payment space, also then later in the blockchain space, to be honest, not so good experiences with that. But everybody is happy to choose his or her path, and to luck, yeah, so all good. But this is an answer that is like a no-brainer from banking side. It helped us a lot to open doors because banks are now more open to talk about stablecoins, to partner so that we can collaborate. And we will, of course, continue to do that. Yeah. But has the banking sector really moved yet? Besides being more open, to be honest, not really. They have formed consortia. They have provided money. Let's see where it leads to.
Yeah, I would also add the cost of inaction argument. So at some point, not building on-chain settlement infrastructure becomes really a strategic liability for a bank or an asset manager. Potentially you have an opinion on this. So at what point does not building on-chain settlement infrastructure become a liability? So did you observe it at some banks that this cost of inaction argument drove them into at least joining a consortium?
Yeah, I mean, it's an interesting point, Michael. I think some of the banks have started to build infrastructure because that's already like even an additional point, yeah, because of like simply wallet infrastructure. I mean, look at these consortia. Who of the 20 banks has a wallet live? It gets very tiny. Yeah. So it's good to start things, but you don't even have the infrastructure to deal with it. So what will happen? The product is live, and then what? Maybe like 3 banks that could even deal with what they issue themselves. How do they want to offer to the client? Really, how? It's technically not possible. And this is difficult, because the strategic decision to invest in infrastructure is, of course, a decision that you should take much in front of the decision to put products on top of the infrastructure. Yeah. And which is our advantage, that we don't have to build on existing infrastructure, that we can build it from scratch. Yeah. And so I think the debt of the lack of a decision to build infrastructure, this point we have passed already since 2 years. Banks that haven't started a wallet infrastructure project, whether it's a custodian or whatsoever, not 2 years ago, hey guys, forget it. Yeah, that's not anymore a make a buy decision. That's a buy decision. Yeah, implicitly, because you won't make it with competitive effort to be ready to put the products on. Yeah, as the clients already start demanding them. So that is, and we have seen that in the market, by the way, that especially also large infrastructure providers that have passed the point of building stuff themselves, that the price is measurable via the investment prices they have paid for buying companies which bring the capabilities to them.
Brilliant. Yeah, so this gives us an important context. This gives us the why of this conversation. So AllUnity announced the Swiss franc stablecoin, and there is an institutional race out there to finally build. Yeah. So if you had told me that when we started this very podcast, I would have most likely loved. But by now we really see that institutional race to build full institutional adoption of blockchain, at least in the finance industry. And this is why we can now proceed to the layer below the coin, to the what it takes or what is beneath the token. So let's do something, Simon, we rarely see in podcast conversations about stablecoins. Let's go ideally layer by layer through the actual stack. So when you zoom out from the token itself and what are all the systems and integrations and components that have to exist for institutional grade stablecoin like yours to function.
Yeah, sure. So I would go through it really in a step-by-step process, maybe from a customer perspective. Yeah. So a customer comes along and wants to get a first buyer with us, so a client of us. Yeah. And what happens is that we are onboarding with him. As a regulated company, this means that you have to undergo regulatory compliant onboarding. Yeah. So we have to check, for example, what is the client earning money with? What is he good for in terms of volume? What is his ownership structure? And then we are onboarding the client onto the platform. So you need at first processes and environments for the onboarding, and you need the technical platform that allows at least this is how we have built it. And I think this is a better standard that we perceive actually as feedback from the clients as it is established in the market, to be honest. You onboard with our platform in a self-administrative way. So you have 2 administrators and 2 users at least, which we also, of course, have to provide with credentials and stuff like that. The administrators can onboard users, and the users can whitelist a wallet and a bank account with us, and they can connect it, which we call mapping. So you have a whitelisted account and a whitelisted wallet. If you combine it, you receive from us a virtual IBAN. So we have a transaction bank in the background that we have to connect to the infrastructure layer of our own platform to provide virtual IBANs. And if you wire money after whitelisting from the account to the virtual IBAN, we will automatically mint the stablecoins as tokens and send it to your whitelisted wallet. So this is the SDP process that I mentioned before. So what does it take? On the money side, we have to have the transaction bank. We have to call the APIs of the transaction bank to retrieve payments and then also trigger the further processes. The bank has to provide virtual IBANs. And our platform then has to take it, to process it, and to trigger a minting process, so to connect also to the smart contract infrastructure. For the smart contract infrastructure, of course, we also need a layer to manage the smart contracts and all the processes around it. So we have a kind of, it's not really a custody component, but it's a kind of key management system to manage the smart contracts, also audited, also, of course, processes that are all institutional grade, in order then to be able to automatically mint actually the tokens on the specific protocol or layer or blockchain. Yeah. And then it's being sent to the wallet that is whitelisted of the client, and thereby the stablecoin is issued. And this process, if the wire goes through directly, takes 4.5 minutes. Yeah. And the same works, of course, for redemption the other way around, where it's then a redemption wallet that we create for the client if the account and the wallet is mapped. And then also if the client sends us back the tokens, we will redeem it for him also in 4.5 minutes and send the money also STP directly onto the account. What happens with the money in between? There we go into the reserve layer, so to say. It's the money that has been received on the transaction account through the virtual IBAN goes into our reserve management. So it will be short-term distributed to cash accounts and later on long-term also into the securities, where we also receive investment advice from DWS to manage the eligible instruments in a way that we can adapt it both towards yield and stability, as agreed upon with BaFin, and also for the transfers, the whitelisting of the wallets and the accounts. We have, of course, also background checks for the wallets, for the activities of the smart contracts, the compliance checks in the background, and so on.
It's
so
like
on.
a compliance and monitoring layer, on-chain transaction monitoring, monitoring sanction screening, travel rule compliance.
Yes, all of course also integrated within our platform, so that if there are changed sanctions lists, that we can within the platform add these wallets to the blacklist, such that it will be automatically also retrieved by the smart contracts in order to block transfers and so on and so on. So there's also this whole kind of transactional layer that will be used then in the day-to-day transaction business. Yeah, so that's maybe a quick overview of the different layers.
Yeah, it's interesting because there are two ways to look at the layer below the coin, or to look under the hood, if you will. One is the customer flow that you just outlined. So looking at it from a customer perspective, and the other is more inside out. That is the actual layers it takes to establish that, such as reserve management and banking rails, the custody architecture, the settlement layer. So which chains, why, and what are the actual settlement, finality characteristics, compliance and monitoring layer, or interoperability. And actually, it doesn't matter too much if you look at it from a customer-centric perspective or an architecture-centric perspective in both. So in each of these steps or layers, then you need to make important decisions as a stablecoin issuer. And I think that's potentially the most difficult, but you know it better than I, is the build versus buy versus partner decision. And each decision then cascades into the next. So if you decide for build in one layer or process, potentially you need to buy, or you need to build, or you need to partner in the other. And this is where your role, the CFO, CPO dual role, becomes so interesting. And that's why I wanted to interview you. So you're simultaneously optimizing for cost at AllUnity because you're the CFO, but then as a CPO also speed to market and product integrity. So you want an excellent product. Are there tensions in your role where you need to make it, where you need to optimize for cost on the one hand, but also speed to market and product excellence on the other, and making these trade-offs?
Yeah, I mean, of course, to be honest, we're also distributing some stuff internally because it makes sense. And back then, the idea was simply to say, hey, it's a financial product. And on the finance side, we also have the treasury, for example. Which is part of the core product also. So it's not only optimizing for costs, but for stability on the one hand, but also time to market, but also then yield, for example. And so it's really multiple dimensions that you have to balance, and for sure there are also tensions within, but our product itself bears these tensions. Yeah, we have to provide a stable product. That's very important, and also be fully compliant. Yeah, because we want to build for institutional clients. And on the other side, of course, we are competing with other stablecoins, yeah, which are pushing very hard on the feature side, but also on the yield side, for example, where we, especially on the yield side, cannot compete. Yeah, on the feature side, so maybe. And this is where we try to balance out that, as I explained also in the beginning, that we can optimize to provide time to market while staying regulatory compliant. This is the core tension of our product itself, I would say, of the regulated stablecoin, that you have to be also very quick on the feature side, on the time to market side, while providing the compliance and the regulatory context to provide really an institutional grade product.
Let's maybe also move to an important player in the market, or potentially an important customer of yours, that is TradFi, that is banks. And please correct me if that's not the case. But I would assume that in bridging the off-chain world of traditional finance and the on-chain world is not easy. Simon, you spent 3.5 years inside Hauck Aufhäuser Lampe building digital asset infrastructure on top of a 228-year-old private bank's technology stack. Okay, I'm over the top here a bit, but you get the point. So when you bolt blockchain onto traditional financial architecture of the old banks out there, where does it break first? What's the first point of issue, if you will?
Yeah, a fun fact is when I used to work at Hauck, I found old account books, and I once talked to the marketing team if we should do a marketing stunt where we write the wallet addresses into the old account books. Yeah, but to be fair, I mean the infrastructure had been renewed in the meantime. Coming to your question, I mean I think each side has its advantages and disadvantages, yeah, and you need to try to leverage in a way that it doesn't break on either side, basically. Because yes, the crypto side is very efficient, very quick. Yeah, if you think about being able to correct bookings, of course, this doesn't work. Yeah, so classical bank transfers are used the process is designed in a way that if something happens, you can still go back and maybe rebook it. Doesn't work for the crypto side. So if you have that kind of accepted breakage in the one hand, but you don't have it in the other one, you have to deal with it that the process is covering it, yeah, because it won't be able to book it back, yeah. Or for example, I mean, and that's a good part of our stablecoin, a very similar one. On the one hand, bank transfers you can only do if people upfront are, let's say, checked, which creates closed systems. The closed systems are very well connected. Yeah, the banks are connected, but the banks themselves have clients, which is a closed system, a closed account systems. So it is easy to take care that the transfer is fine. Yeah, but you cannot go over the border of the closed system. The stablecoin works the other way around. You can send it to anybody. Yeah. So it's very open, which also creates the efficiency. But you have to bear with the fact that it's not as easy to implement sanctions. Yeah, because in closed systems, you can enforce sanctions easily. China can enforce sanctions best because it's maybe politically the closest, the most closed system. Yeah. So how do you deal with it? I mean, you have to build bridges, yeah, some way. So, for example, for the tokenized securities, yeah, the German law on electronic securities foresees that a registrar has to also know every customer or every entry client, yeah, of the register. This creates a closed system within the open one. So you can transfer between the different registrar clients to transfer securities. This is open without an intermediary, but still it's a closed system. Yeah, so it's easier also to enforce stuff within. But it is basically whitelisting. If we would do a whitelisting on the stablecoin side, it would create a closed system and nobody would use it because the restrictions on the money side are not as tight as on the security side. So however, if we don't have any restrictions, no blacklisting, no whitelisting, we cannot enforce sanctions in any way, which is not regulatorily compliant. So you have to find a bridge and compromise in form of the blacklist, where it's still open, but you can enforce it.
Yeah, I refer to this the identity layer mismatch. So TradFi knows its customers through KYC, AML processes tied to accounts. Blockchain in turn uses anonymous addresses. So the challenge is, how do you map one to the other at scale while preserving the benefits of both worlds? And then the regulator has a say in that too. So I agree, this identity layer mismatch, I would assume, is a major challenge in building and issuing a stablecoin.
Yeah, and that's a kind of mechanism like to bridge TradFi and DeFi, or like old and new world, if you want to put it like that. Then there were like in history, so like before, there were of course other points like core banking systems cannot deal with 7 digits after the comma. Which is an issue but that's a kind of, you know it once and then you have to deal with it, and there are ways to circumvent it. But you could do, for example, Satoshis. You book Satoshis and not Bitcoins, then it works again. But that's not the critical thing. The critical thing is really where the process in the existing world relies on a paradigm, and also the processes in the new world also relies on the paradigm. And the paradigms don't match, like the open system and the closed system. And then you have to find a compromise, a way how to bridge these two paradigms in order to work in both worlds.
Yeah, what I would maybe add to your list is the reconciliation problem. I think TradFi runs on end-of-day batch reconciliation, and blockchain is real-time and atomic. So I bet you face the challenge of how to bridge those two worlds without just building a parallel system.
Yes.
And what I find often in projects as an architect myself is core banking integration. So, and that's actually a question to you now. So did AllUnity have to build kind of a middleware to talk to traditional banking systems? And what does this interface then look like?
I mean, yes, of course, our infrastructure, our platform that we built is talking to banks, not maybe directly to core banking systems, but to APIs of the bank, to our transaction bank APIs. And through these APIs, we receive incoming payments, but we can also trigger outgoing payments, which actually creates this STP processes. However, as you have described it, 100% correct, existing world works with batch processes, while stablecoin can immediately transfer, which means there is a time lag, potentially. If a client wants to redeem on the weekend, and we cannot do transactions from a reserve account to a transaction account on the weekend, then there's a delay. So you have to build a bridge again. And this bridge doesn't need to be technical. One way is, of course, if the transaction and the reserve bank are the same, you can do internal transfers probably also on the weekend. And for that reason, enable then also an outgoing payment. The other one is also very simply, you provide a liquidity buffer and price it in the total, let's say, cost of capital. Because the liquidity on the transaction account you can provide despite the reserve still being protected. And thereby enable also quick payouts.
Brilliant. At the moment, we talk on the more general level of where TradFi architecture breaks. So the general challenge of bringing TradFi and or CFI DeFi architectures together. And now I want to deep dive into a case study to give an example, to make it specific, and that what else is AllUnity. And I want to move into specific decisions, architectural decisions the team had to make. So let's make this concrete. AllUnity is now building a Swiss franc stablecoin while already operating a euro stablecoin. This means I bet you had to make architectural decisions that accommodate multiple currencies, potentially multiple regulatory regimes, and multiple use cases. What were the 2 or 3 most consequential design decisions, the ones where the team genuinely debated, had to sleep over, where the answer wasn't obvious, if any? Potentially it was super easy. Yeah?
To be honest, I mean, on these topics, I think there was a large consensus in the team. Yeah, so here I think, as you have mentioned before, building the infrastructure ourselves was a more critical one to enable the scalability, simply because you don't rely on the partner implementing it for you. That's the very simple one. But this was some decision that we took also kind of a while ago. The more debatable decisions are, without teasing too much, for the stuff that's still coming up, besides multiple currencies, because we're not only, of course, working on multiple currencies. So there's yet a lot to come, which I cannot disclose yet. But this stuff that is potentially also even more interesting, that's something that we actually debate more about. Yeah. But with regards to the multi-currency decision, I think it's a bit, to be honest, as you have correctly described already before. So the decision to make or buy for the own platform, that was a strategic decision that leveraged this definitely because we were more flexible. Second decision is, of course, the decision towards the partners we are working with. And this also is coming down quickly to the banks, because it pretty much depends in terms of capabilities on which banks you're working with. And then it's not only your decision again, but also the decision of the potential partner if they actually want to work with you, because that was even a bigger issue. So if we would have had like free choice, we would have worked probably even with more and also diverse partners, where we would have even more capabilities to scale quicker. But sometimes it's simply not possible. It takes a lot of time, or they say it's not possible whatsoever. But I think we made good choices with the partners that we have, because they enable us here to scale due to their internal capabilities, both technical, but also with regards to market reach and, for example, which currencies they offer. Yeah. And then third decision is people. And it's basically, I think, the first one, to be honest. Yeah. Because the question, if you want to go into that direction, and this is also reflected in the consensus about this direction, is heavily dependent on whether you have the people that are willing to do it. Yeah, because ultimately everybody can make plans, and everybody can talk about things a lot. Yeah. The differentiating factor, which has also been the same for Hauck, for Deutsche Börse, for Commerzbank, is very simple. Yeah, I was on an event last week by a very large, well-known consultancy firm that brought together people discussing, I would say, digital payments in a larger way with European focus last week. And one of the questions was like, of course, why it is so difficult in Europe and why we are falling behind. And hey, to be honest, my simple answer is because too many people don't do it. Yeah, that's the very, very simple answer. And if you want to build it like that, the critical decision is, whom do you choose as a team member who's willing to do it? Yeah, that is something where we're also very cautious, to be honest. Yeah, whether here there's a proper fitness really in that way, being able to build stuff. And I think we have done here maybe even the better decisions than on the technology and on the partnership side.
Yeah, brilliant. These certainly weren't the items I had on my list, so the decisions that keep you up at night. What I usually then see at stablecoin issues is, for example, the compliance decentralization spectrum. So how far toward DeFi composability can you go as a stablecoin issuer before a regulator gets uncomfortable? Or speed trade-offs like MiCA mandates certain reserve and redemption structures, and how does that interact with the desire for instant on-chain settlement? Yeah, so that's what I would have expected as kind of the trade-offs or decisions that were a tough call for your leadership team to make. But yeah, I understand the partnering decision to really build and not just talk was even more important and potentially demanding more of your time than the examples I listed.
Yes, and to be fair and honest, I mean also decision corridors on for example, in how far are we able to build something that is towards DeFi or within Mika or not. These decision corridors are narrower than you would expect. Yeah. So you have to issue in a compliant manner. You have to distribute in a compliant manner. Then upfront, of course, we are working with partners here as well, also in the DeFi world. But that doesn't change anything on the issuance and distribution side from our side. Here we just have to be compliant. Yes. So here the decision corridor is really narrow. Yeah. However, I see your point that, hey, you are taking decisions on where to go. But we don't have that much spread, so to say, here.
Yeah, so I certainly want to make sure that I do capture your CXO, your managing director perspective today. So far, we really talked about the layer below the coin, the architecture that brings a stablecoin, specifically your stablecoins, to life. But since we're having you as a CFO and CPO, I certainly want to talk risk, business case, institutional adoption. I want to learn what keeps the stablecoin CFO up at night. So let's talk about the risk surface that most people don't actually see when they think about stablecoins. You're the CFO of a stablecoin issuer. The token is live. It is being used. So what are the scenarios that keep you up at night? The ones that aren't about like price volatility because, well, it's a stablecoin. So of course you want it to be stable, but are there other risks that keep you up at night?
To be honest, I think an advantage, and I think you need to have that, is that I can. My job is to deal with risks. So to be honest, I'm not kept up that night. I sleep well, yeah.
So that sounds like operational excellence. You're not expecting fire calls at night.
No, I mean, to be honest, we have to deal with risks. Yes, and there are potential risks that you could think about. For example, depegging. Yeah, but here I'm pretty relaxed. If we depeg, I'll buy the stablecoin myself at every volume that I can, and I will redeem at par value because this is a legal obligation and I know where my reserve is lying. Yeah. So depegging is best economic effect that everybody could have. Yeah, because it's a risk-free deal. Yeah. There are other risks, of course, which is like, have we really done everything that we need that is required from the regulator?
Yeah, but Simon, come on, I'm not fully buying that you sleep so well each night. I mean, let's take alone reserve integrity and proof. Aren't you concerned about how you really prove reserves are there continuously, not just at audit snapshots? Or is real-time proof of reserves technically feasible and desirable at all?
Real time, I don't know if it's necessary, to be honest. Yeah, but we'll also do our audited reserves and publish them soon. That's another feature that we are going to bring live soon. I look, really, to be honest, I know the reserves because I mean, yes, I'm CFO, but hey, the company is small. I'm still also doing reserve management on my own. Yeah, so I know pretty well where the reserves are, how much they are. I know the processes. I also know that our processes are straight through processing, which means that we cannot mint like other competitors have accidentally done with like $3 trillion. Yeah, I cannot mint manually. So I'm also, to be honest, pretty relaxed about creating fake money that doesn't exist, which would be for me like two of the most critical ones. Yeah, I'm really more worried, like, have we done everything that is required? Yeah, of course, I could also think about counterpart risks of our banks. But I know our banks, they are very well established. So I don't see, there is a counterparty risk, full stop. Yeah, and you have to deal with it. Yeah. But if a bank goes broke, of course, this would be an issue. What I think about is, for example, of course, more the forward-looking things. Yeah, I mean, we have good investors. For that reason, we are well financed. But we have to provide also then, if we have growth, regulatory capital. Yeah, and I need to ensure that we always have enough regulatory capital, even if there's a lot of minting incoming and maybe a big payment incoming from the company side, where I have a larger cost position than expected. And then in one point of time, there could become there could be a situation where I don't have enough regulatory capital. Yeah, and I have to announce this to BaFin, and do I have the mechanisms to announce it quick enough to report it? Because otherwise I have a reporting breach. Yeah, because our currency as a stablecoin provider is not only the tech and the features, but of course providing an integrity. Yeah, for payments. Yeah, and this integrity is of course related to, do we manage our business in a compliant manner? Yeah, so this is something that I have to ensure more, or where I worry more about than deep pegging or something else.
Yeah, time is really passing fast. One thing I do want to make sure, though, is to capture your advice to any bank CXO. So I would assume that your advice is now to the CFOs and to the CPOs, if available, at banks, or potentially then CTOs even. So let's say a bank CXO in Munich or Zurich or Amsterdam is listening right now to this episode and thinking, okay, I need to take this seriously. So based on everything you, Simon, you've built and learned from Haug Aufhäuser, Lampe to AllUnity, what would you tell them? Where do they start? What do they build? And what do they leave to specialists?
Okay. With this framework, I will start, as all like CXO discussions, within a very large picture, like kindergarten level. And every CXO will be probably self-confident enough to laugh about it. Yeah. No, but seriously, look at the long-term development of businesses within innovation. I think no business has died out because it hasn't managed the existing process operatively perfect enough. No business has gone bankrupt or decreased in value at large scale because they haven't done cost optimization perfectly and squeezed out the last 2%, or provided perfect financial allocation, capital management. But Kodak has died because they missed digital pictures. Sony has lost lots of customers because they missed digital music. Linear television has lost clients massively because they missed streaming. Companies, if you are thinking below your 2 years contract as a CXO, have lost customers and clients and business, even going into bankruptcy or whatsoever, because they have stuck too long to their existing processes and have not embraced fully fledged upcoming innovations in a way that was even maybe separate from their existing business. Yeah. And now there is a payment mechanism that is now even regulated, and it enables you to pay, but also even upfront manage currencies and liquidity 24/7, instant, in multiple currencies, for almost no transaction costs. And you are not spending the thought on it and how it may impact your business. And even worse, that are effects that we're talking about now. Yeah? But the secondary order consequences, as for the digital picture, as for the digital movie, as for the digital music, they are not even priced in yet. Because the payments becoming digital themselves, the money actually becoming digital, so not only digital processes, but digital money, which a stablecoin is, enables even further business cases within your existing business that you are missing. Because you can, for example, pay for usage. in a way that it eradicates the point of sales in a classical way, because there is no pull payment anymore, but instead you agree that you pay per usage. Yeah. And this integration of digital money into your business process enables completely new business models that you're going to miss. And now you decide upon, do I want to play in this game? And the first step you have mentioned before is the infrastructure piece. And you as a CXO have to ask yourself, what is the infrastructure piece that I'm missing? And if I don't invest in that infrastructure, what am I missing out in opportunities in 5 to 10 years? And this piece of infrastructure for blockchain is very simple. It's wallets and key management. How can I, as a company, enable that I am able to do transactions on a blockchain in a corporate scale? So be very, 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 very quick to get wallets and to see how you can integrate it into your existing world and manage transactions, including key management within a company. And then second, think about what are opportunities that I'm missing out via integrating digital money into my business processes.
You're really convincing pitch, Simon. I bought it. I bet many of those CXOs in Munich, Zurich, or Amsterdam that heard it will think twice now and carefully reflect. Let's assume there is a subset of those listeners who now, which hasn't started but wants to start. And there are two camps, if you will. There is the start with custody camp or argument. So start interacting or building on the on-chain world with custody. And then on the other side, there is the start with use case camp or argument. Which is right? Should an institution simply start with custody and see where it goes? Or should a stablecoin use case, now talking about the stablecoin industry, like treasury management, be the first step in extending an institution's business into the on-chain world?
I think there's no or, it's both. Yeah.
In parallel.
So yes. So because you have to also make experiences. This is very important. Yeah. Most people underestimate experience and overestimate strategy. We all know the saying, culture eats strategy for breakfast. I would say, if you don't have experience, strategy is pointless. So experience eats strategy for breakfast as well. Yeah, which doesn't mean you don't need to have a strategy. But hey, guys, if you don't know anything about the topic and you theorize about a strategy, come on, what's the point? Yeah, I mean, if you as a CFO of or also CEO of Kodak wouldn't have used a digital camera and saved a picture on a PC and printed it, what is the point of doing a strategy about it? Yeah, and so for me the custodial angle is a no-brainer. Just take care of it. It's basic infrastructure. It's like Kodak thinking about whether they should buy PCs. Come on, that's a no decision. Buy fucking PCs. Yeah, and wallets are even not that expensive than PCs back in the days. Yeah, just get a wallet. Yeah, deal with it. Get along. And the second thing is use cases where I'm really about do not strategize, but let people try out. And this is the fun fact. If you are a large organization, and you can see the same effect, by the way, who were the inventors of these stuff? Who invented Lamborghini? A Ferrari employee, right? So, guys, you have already people in your company who are interested in this stuff because guess what? They just don't want to deal only with their jobs. They're interested in the new stuff. Give them the opportunity to try it out and then try it out yourself. And you'll figure out along the way. If you don't, they will move. They will found a company which becomes your competitor and replaces you one day.
Excellent. So it's not an either or, it's simply both at the same time. Start with custody as a fundamental component and learning curve. And at the same time, ask yourself which use cases are most promising for your institution, for your key customers, to also then use this wallet infrastructure or this custody capabilities that you have to build in either case for any use case, right?
And I would really stress the experience point. So here, before you do a strategy consulting, 100K 1-year project to define your digital asset strategy, blah, 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 blah. Guys, give the people in your company a bit of money and time to try it out, and then look at the experience. And then you can still do your strategy project if you like to, but don't do it up front. Yeah, and don't try to just buy it in. You have to experience it yourself.
Yeah, I think this excellent advice and closing words leave nothing for me to add, guys. Give your teams money to gather experience. I love it. Yeah, the title of this episode is The Layer Below the Coin. And I think Simon and I have shown that the real competition in stablecoins isn't about, it's easy to announce a token. The actual competition is about who builds the most robust, compliant, and interoperable infrastructure and risk management underneath it. So Simon, thanks for going deep on this layer below the coin with us. And to the audience, thanks for listening and for making it until the end of this very conversation. If you enjoy the podcast, please recommend and rate us. That helps us the most. And connect with us on YouTube, LinkedIn, and our expert community on Telegram, both in German and English. And I think, Simon, you are also part of that. If not, we'll make sure to get you in this expert community. And make sure to subscribe to BFRR wherever you get your podcasts, and join us next week when we'll be exploring another critical development in the evolution of digital finance. Until then, this is Bitcoin, Fiat, and Rock'n'Roll, bringing Europe's perspective on digital currencies to the world.
The views expressed are solely the personal opinions of the hosts and are provided for informational purposes only. This podcast does not offer financial or investment advice. Always conduct your own research and make well-informed decisions before investing. Please be aware that the hosts and guests may hold cryptocurrencies or digital assets discussed in this episode.